think this is the single best year of gold performance in my lifetime. Obviously, retail investors have been buying Bitcoin for 15 plus years. They've done a pretty good job of creating value there, right? Again, it is.
Bitcoin actually down a little bit over the last couple of weeks. What is going on, and should we be concerned?
Well, if you take time horizon, you say, okay, since the beginning of the year, gold's up 42%. I think this is the single best year of gold performance in my lifetime. It's pretty crazy how good gold is doing right now. So hats off to the gold holders. Obviously, they've been right. I think gold holders and Bitcoiners were kind of brothers in arms in terms of our fight and plight against the debasement of currency. But gold guys are doing fantastic, and I'm happy for them, right? Also, as we've talked about in many episodes over this year, is usually gold runs first, about 100 days later, Bitcoin runs next. And so the higher that gold pushes, the more that I expect Bitcoin to kind of whip upwards as well in the kind of last 4 months or so of this year. So I don't think that this story is over yet. I still think that there's a very good chance that Bitcoin will actually end up outperforming gold for this year, which I think is right now maybe not a popular view, but we'll see. But if gold outperforms Bitcoin, then that's perfectly fine too, right? Like I don't think that these two assets are necessarily in kind of a zero-sum competition with each other. I think that what you have seen is as Bitcoin has risen in popularity and in market cap, you also have seen gold become more popular as well. So those two things I think are actually kind of all boats rising together, which is very important. So that's first. Second is, why is gold going up? It's a very important question. Well, central banks are buying a lot of gold, right? And central banks right now are probably the last set of buyers on the planet that are not openly buying Bitcoin. So if you think about it from that perspective, you basically have retail, you have institutions, you even have public companies now buying Bitcoin. Many of them also buy gold, right? Public companies maybe a little bit less than financial institutions, funds, individuals, whatever. But for the most part, those three buckets of kind of allocators, they buy gold and they buy Bitcoin. There's a new report out from Deutsche Bank that talks about the fact they believe in central bank portfolios and balance sheets by 2030, you're going to see gold and Bitcoin both there. So I think that if you are looking at kind of month to month or even, a 1 year time frame, it looks like gold or Bitcoin can go higher than one or the other, mainly because you see both the macroeconomic environment, interest rates, and then the buyer set kind of changing what they're doing between those two assets. But over the next 5 or 6 years, I think that Bitcoin has a structural advantage in that there are still very large pools of capital who do not yet have exposure to this asset, but they will get that exposure. And when they do that, you have a lot of capital coming into a finite supply asset that should push the price up over time. And so I think everyone's just got to remember, like, you don't need to have very low time preference, or excuse me, very high time preference. There are too many people who are so worried about, did Bitcoin go up or down today or this week or last month? Instead, think about Bitcoin over the last just year. Bitcoin in November of 2024, all the way back to the end of last year, was at $69,000. It is up almost 2x in less than a year. And Bitcoiners are complaining. That is unreal performance. And so when you look at that, you say to yourself, okay, hold on a second here. Yes, if you go back and you look at gold since the beginning of 2024, it's up a lot as well. It's up 42% just in 2025. But Bitcoin is up more than gold since the beginning of 2024. And so you can play this like manipulation game with data all day long and say, oh, okay, well, if we go back 9 months, then gold's winning. If we go back 12 months, then Bitcoin's winning. If we go back 18 months, then Bitcoin's winning. Like, right? At the end of the day, these two assets likely have a position in most people's portfolio, is that they're going to own some gold, they're going to own some Bitcoin. Now, I do not own gold. I've been very adamant about it because in that corner, or maybe a dinner plate of my portfolio, I want max volatility and I want max risk taking, right? I'm not looking at something like Bitcoin as I hope it ekes out 8% a year, right? I can use other instruments in financial markets if that's what I was looking for in a part of my portfolio. I can go and I can buy the S&P, I can buy, these other various assets. If I want max volatility, max return, max kind of asymmetry, and max risk, then buying something like Bitcoin is obviously what I'll do. And so I think it just really comes down to like, what are you looking for? And, Cantor Fitzgerald recently came out with this fund that I think is pretty interesting. They've got a Bitcoin gold fund, and their thought process is Bitcoin can drive financial returns on the upside. Gold can protect on the downside, right? There's less volatility to it. Gold's up 42% though. So, in that case, gold and Bitcoin both do really well on the upside. And the thought process would be if there was some sort of market downturn, gold would be able to weather that better than just Bitcoin alone. So I think you're going to start to see people play with these ideas of, okay, you have two store value assets. They both benefit from currency debasement. They both benefit from cheaper capital in the market through lower interest rates and money printing. And so if that's the regime we're headed back towards, which that's what it looks like we're headed towards, then I think you're going to see both of these assets do well. And you can play this game of, in the short term, who outperforms who. But again, I think that there is a good chance. I don't know if I'd say there's a 100% chance, but more than a 50% chance that Bitcoin still outperforms gold in 2025. It's just that gold runs first, then kind of Bitcoin catches up, and let's see what happens.
Where does the price start to catch up for gold and Bitcoin? Do we need central banks to come in, or can these treasury companies kind of support the market?
I think treasury companies in general are just one of many buyers in the market, right? Obviously, retail investors have been buying Bitcoin for 15 plus years. They've done a pretty good job of creating value there, right? Again, it is a finite supply asset. The more demand that comes in, the higher the price goes. Retail has a lot of money, and they've plowed it into Bitcoin, especially young retail. And so that has driven the price over, a decade and a half. Now you also have, though, institutions. And, one of the things that's really interesting to me is take BlackRock as an example. Nobody would describe BlackRock as a Bitcoin company, but BlackRock is a Bitcoin company. Why? The number one product in terms of profitability inside of BlackRock, from what I understand, is the Bitcoin ETF. Their most popular, most profitable product for BlackRock is a Bitcoin ETF. Doesn't that make them a Bitcoin company? Right? If your biggest products are in the crypto industry, aren't you a crypto company? Right? And so if you say to yourself, okay, hold on a second here, then if you go and you look at a Robinhood, right? Or any of the companies that have really embraced this stuff, if crypto was their biggest sector, which it is not on Robinhood, right? But if it was, I think a lot of people would be like, oh, that's a crypto company. So if in the fintech space and the innovation component of financial services, if you are labeled as a Bitcoin or crypto company because of the size of the revenue that is coming from crypto versus other things, why doesn't that apply to traditional Wall Street? And so it sounds weird to say BlackRock is a Bitcoin company, but they're a Bitcoin company, right? That is the single most valuable product that they have in terms of profit. And so I think that you're starting to see the melding, and this is really important, is yes, will the central banks coming in be important? Of course. But BlackRock's sales team, they work for Bitcoin. They're out talking about the Bitcoin ETF, right? They're knocking on doors. They're educating people. They're doing all this stuff. BlackRock doing that, nobody thinks of it that way. Bitwise, on the other hand, which I think many people would think of as the leading crypto specialist, what are they doing? They're out explaining to people, educating them, helping them better understand Bitcoin and cryptocurrency. And so I don't know how many employees Bitwise has now, but it's a lot, right? They do a fantastic job. I've always said Bitwise is winning the ground game. Right? They're knocking on doors, they're meeting with advisors, they're helping people understand this stuff, and they're getting them into these products. Okay, well, if BlackRock's doing the same thing, aren't both sales teams working for Bitcoin? Aren't they working for the crypto industry? So I think that's the stuff that people got to kind of start wrapping your head around. It's like there's this blending that's happening where you can't say that one is a crypto company and one is not. Crypto or Bitcoin is just going to be a part of finance. And you see this with the exchanges, right? You see Robinhood added crypto. Kraken is adding US equities, right? Coinbase has talked about potentially entering into tokenized stocks. Okay, well, hold on a second. Aren't the exchanges all just going to offer stocks, Bitcoin and cryptocurrencies, and prediction markets? Aren't they just going to be exchanges? Of course. So it all just becomes, I'm an exchange, right? Then if you go and you look at, let's say, custody. It used to be that there was Bitcoin and crypto custodians, and then there were banks, and those were two completely separate things. Well, now some of the crypto custodians, Anchorage, they have federally chartered bank licenses. If you look at Custodia, right? They're going and pushing further into Fed master accounts and things like that. Okay. But then also, if you flip around and you look at the traditional legacy financial system, those players are all trying to get in the custody game. And so whether it's BNY Mellon, whether it's the kind of large banks, like all those groups, they want to be in the custody game too. And so what you're seeing again is a melding. We just custody our customers' assets. And so I think what people have to start to get very comfortable with is Bitcoin is not winning until we can stop describing things as a Bitcoin company, a Bitcoin product. We need it to just be a company or a product. The Bitcoin part should be assumed. Nobody says, oh, I have an account at Bank of America. It's a fiat bank account. No, it's just a bank account. Of course, dollars are there, right? That's where we got to get to. And so I think we're getting closer. We're not there yet, but I think we're getting closer. When that starts to happen, what you're going to see is a lot of capital flow from these organizations, but bigger percentage. And I think that you're going to start seeing this like assault of capital into Bitcoin and cryptocurrencies, but Bitcoin in particular. And over time, the price will keep going up.
Why are these companies commanding such high premiums compared to everything else?
Well, different investors look at it in different ways. So there's not going to be one single answer. The way that I've always thought about the MNAV premium is it is the quantitative measurement of how much the market believes you're going to buy more Bitcoin, right? And
you think it's buy more Bitcoin, not that Bitcoin appreciates to close that gap?
No, because if the Bitcoin's going to appreciate, then your Bitcoin per share is not going to change. And so as Bitcoin appreciates, the stock price should track relatively about the same, right? So if you got 100 Bitcoin and 100 shares, that's one share for one Bitcoin. If Bitcoin doubles in price, then you would expect the share price to about double in price, right? Because you still have one share for one Bitcoin. So what's the share worth? Well, it's worth one Bitcoin. Bitcoin has doubled in price, so the share should double in price, right? What is really driving a lot of this is growing Bitcoin per share. So this is this whole idea of like accretive accumulation of Bitcoin. And so when you get that accretive accumulation, what people are basically saying is, okay, how quickly do I think Bitcoin per share is going to grow, right? How much do I believe they're going to buy more Bitcoin in a accretive way? And then what I'm essentially going to do is I'm going to put some multiple on the current situation because they're going to grow into it. So all the numbers for each company are a little bit different. It's very hard to kind of use one company as an example. So let's just use a hypothetical, but let's say that again, 100 Bitcoin, 100 shares, one share per Bitcoin. And I think that the company is going to be able to go from 1 Bitcoin per share to 2 Bitcoin per share. They're going to double, right? Which would basically be yielding almost 100% for in let's say a year. Well, people may say, you know what? I'm actually willing to pay today at the beginning of the year. If I think that they're going to double their Bitcoin per share, I'm willing to pay a 80% premium. Because by the end of the year, they're going to have doubled. And so all I'm doing is I'm just paying up for the future growth that they're going to grow into, right? Now, again, each company is different. Some companies are trading at like 400%, even though people think they're only going to double, right? Whatever. But it's no different than why don't people buy, Meta stock or Amazon stock at 1x revenue? Well, because there's growth, right? And so they're willing to pay a multiple to account for that growth. So if I think that Meta is going to grow, again, just use easy numbers. If I think they're going to grow at 50% year over year revenue and profit, then maybe I'm willing to pay 20 times their revenue today. And I just look out and I say, okay, well, 20 times is X percent growth for Y number of years. And that's what I'm essentially doing. Right. And so it really depends on like what's your time horizon? What do you think the growth rate's going to be? What risk do you see? Like there's all these things that feed into it. And I think one of the parts that people don't want to talk about in the Bitcoin treasury world is like, we're still figuring out what the market thinks, right? There's been certain situations where things have occurred that have given us data points. Right? A very obvious data point to me was when Strategy came out and they said, we're not going to sell common shares via our ATM at anything below 2.5 times MNAV. Okay. Well, immediately the MNAV premium started to collapse. Not their fault, right? They had a hypothesis, most likely, I haven't talked about it, but like most likely, hey, if we give the market guidance, then they'll understand our kind of decision framework. Got it. Well, all of a sudden, as that MNAV premium started to compress, they said, oh, wait a second, maybe the market actually doesn't like that guidance, right? And so they turned around, they said, actually, you know what? We're going to open that back up and we're going to change our guidance, right? MNAV premium started to expand again. Like that to me is a sign of intelligence from the strategy team saying to themselves, hey, we did something. We saw a market reaction. It gave us more information. We changed our mind. Like that is the definition of intelligence. You get new information, you change your mind, right? When it's appropriate. They did that. So I think everyone else though, and I've seen other people talking about this both publicly and I've heard people talk in private, is that was a data point that actually maybe the market doesn't like very rigid guidance on when you're going to tap certain capital market tools.
Do you think AI could replace the Fed?
Of course.
How and why?
Well, AI can replace an accountant. AI can replace a lot of white collar workers. What does the Fed do? The Fed ingests data, it synthesizes it, and makes decisions that are supposed to be data dependent and programmatic. Doesn't that sound like a computer? So why couldn't it? Are we really claiming that the Fed board governors are smarter than a computer? We know the computer can do better math. We know the computer can both collect and synthesize data better than humans. So why can't it make a decision on the interest rate?
Is there anything the computers have a disadvantage at in that scenario?
Yeah, of course. The political aspect, right? Whether people like it or not, like it's all politicized. It's always been politicized, right? People are like, oh, the Fed's always been independent. Get out of here, right? The Fed has never been independent. The Fed is run by humans. It's like saying like journalists are unbiased. Get out of here, right? They're humans. By the way, it's not their fault. They're human, right? Some reporters do a much better job in terms of at least putting on the facade of being unbiased, but everyone has bias, right? So the Fed has bias too. If they were unbiased, they wouldn't be donating to one political party or another, right? They wouldn't be commenting about politics, right? They wouldn't be doing all. So like, just throw that out for a second. Forget all this nonsense about the Fed independence, all this kind of stuff. All noise. A computer can do the Fed's job better than the Fed, obviously. The question is, do we want a programmatic monetary policy or not? Because what happens, use Bitcoin versus the Fed as a good comparison. The Bitcoin monetary policy is programmatic. It was set in 2009 and pretty much has run since, right? 2008, 2009. That policy does not care what's happening in the world. Doesn't care if demand has changed for Bitcoin. Does not care about geopolitical events. It does not care about a global pandemic that locks everyone in their home. It does not care about any sort of controversy as to who the president is. Does not care about who is in the Senate or Congress. Does not care what you did today. Does not care what anyone ate for breakfast. It doesn't care about anything. It just knows I run block after block after block of transactions, and based on a certain timeline, I emit a certain number of Bitcoin to incentivize the miners. And the monetary policy is going to continue running to about 2140, and there's 21 million Bitcoin as a set amount, blah, 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 whatever. People know this, right? That programmatic policy does not care what happens in the world. Flip, though, to the Federal Reserve. The Federal Reserve, all it cares about is what is happening in the world. So on one hand, you have a monetary policy that is immune to changes in the world and is, I would say, offensive. It's not reactionary, it's offensive. This is what we're going to do. The world must conform to me. That's what a programmatic monetary policy does. The world has had to figure out that Bitcoin is valuable. Bitcoin didn't change. The Fed is different. The Fed is reactive. The Fed looks around and says, show me all the data, give me all the things that are happening in the world, blah, blah, whatever. Okay, here's what we think we should do. So they react to everything, which means that Bitcoin, a programmatic monetary policy, says the world must react to me. The Fed says we will react to the world. Well, which one do you think is better? Obviously, the programmatic monetary policy. Because what it begs the question is, how do you plan your life if you do not know what the cost of capital is going to be, not only in 5 years, but in 6 months? Right now, if you poll Wall Street and Main Street and you ask them, what is going to be the federal funds rate in January of 2026? You're all over the place.
Yeah.
If you go into the Federal Reserve Board governor meeting, which they did in September, and they said, show us what's going to happen through the end of the year. One person said that they should hike interest rates. Another guy, Stephen Myron, said that they should cut interest rates 5 times. Hold on a second here. The 12 people that are responsible for creating monetary policy in this human-led centric model, they don't even agree in unison on whether we should hike or cut, let alone the severity and the number of moves. This is chaos going on. So it comes back to this idea of programmatic monetary policy is better because a programmatic monetary policy tells you what the cost of capital is going to be in the future. If you know what the cost of capital is going to be in the future, you can then plan your life. And so what we are requiring people to do is to guess what the humans are going to guess about in the future. To make matters worse, the Federal Reserve, again, I'm going to give them the benefit of the doubt, say they're not intentionally misleading people, but they have misled the market multiple times in the last 6 years. In 2020 and 2021, they said that interest rates are going to remain suppressed near 0% for an extended period of time. In 2022, they said, just kidding. And they hiked interest rates at the fastest rate in history to the point where they brought professional risk managers who run banks down to their knees and put them out of business. Crazy. Now, were the banks wrong for not managing risk well enough? Of course. But also the Fed told them that interest rates were going to be near zero. And so if the banks got it wrong, do you think Joe on Main Street or Sally walking around Manhattan, you think they got it right? You think they're smarter than the banks are, whose entire job is to do risk management and to trade around interest rate decisions? No. So it's just a completely asinine model that not only has been destructive to the everyday lives of Americans, but on top of that, it has been inaccurate. And we've seen that. They continue to be behind the curve. Why are they behind the curve? Because they're reacting to the world. They wait to see what's going to happen in the world. It happens, then they act. Duh. Of course you're going to be reactive, right? So the problem becomes now there's psychological scarring at the Federal Reserve.
How do you get information on what is going on accurately?
Stop asking people what they think and just look at what they do. Like, duh, easy. Like politics learned this lesson really hard. Stop asking people who they're going to vote for. They lie. Like, duh. Freaking guy on Polymarket from France literally destroyed everyone because he said, well, what if we don't ask them what they're going to do? What if we ask them, it's called a neighbor poll. Who's your neighbor going to vote for? All of a sudden, everyone told the truth, right? Like, think of how crazy that is. In politics, polling, if you ask somebody who they're going to vote for, they lie to you. If you ask them, who is your neighbor going to vote for, they tell you the truth. Okay, well, in the Fed, stop asking people, what do you think you could rent your house for? Have you ever talked to someone who's trying to sell their house or rent their house? They're insane. They list it for some crazy price, and then the market tells them, you're dumb. It's going to sit on the market for 500 days, right? Or you got to lower the price. So, of course, if you ask people, they're going to give you bad data. On top of that, if you ask people a sentiment survey, when would you ever trust the crowd's sentiment to make decisions? Like, you got to be just absolutely out of your mind. Again, go hang out with the unicorns and my 3-year-old, right? Like, what are you talking about? Instead, you want to know what rent looks like? Go on Zillow, Street Easy, or the 50,000 other companies that have been created over the years, and just look at what did houses rent for last week in a certain geography. And guess what? Now you don't need to call 2,000 people out of a country of 330 million Americans and then hope that they licked their finger, stuck it in the air, and got close today. Instead, you can look at big data sets. You can use a computer. You can use things like simulations and scenarios, and you can start to predict it. So here's a little plug for you. You know that company, Sylvia, the product that we built? People may not know this. Once you put all of your assets in there, your stocks, your crypto accounts, your real estate, your cars, your credit cards, your debt, well, any assets you got, you put into Sylvia, it gets anonymized, it gets encrypted, and then we overlaid all these AI things. You know one of the crazy things we can do in there? You can now do Monte Carlo simulations. You can tell Sylvia, I want you to run Monte Carlo simulation on my portfolio, run 100,000 simulations, and tell me where I'm likely to be in 10 years.